Hello everyone. Welcome to our Class 10 Economics presentation. I'm excited to have you all here today. We will be exploring the topic of money and credit, which is a crucial part of understanding how our economy functions. Throughout this session, we'll cover key concepts related to money, banking, and how credit impacts our daily lives. So, let's get started and dive into this interesting subject together. Today, we're going to explore the idea of exchange without money, which is a fascinating concept rooted in history. One of the main challenges with this form of exchange is what we call the double coincidence problem. Essentially, for two people to trade directly, both must want what the other has to offer at the same time. This often made exchanges complicated and limited. To address this issue, people developed the barter system. The barter system is simple. You exchange goods or services directly without using money. For example, if you have apples and need bread, you might swap your apples for bread with someone who has it. While this system worked in small communities, it had its drawbacks, mainly the double coincidence problem we mentioned earlier. It's a great way to understand the origins of trade, but it also highlights why money eventually became necessary as a more efficient medium of exchange. So, this slide helps us see the roots of economic exchange and how early societies attempted to solve the challenge of trading without money. Let's start by looking at the idea of easy exchange. This is a fundamental concept because for any form of money to be useful, it needs to be easily exchanged. People should be able to trade it smoothly without complications. When exchange is simple, it encourages more transactions and increases trust in the monetary system. Next, we have common acceptability. This is a crucial point. For money to function effectively, everyone needs to agree that it's valid and legitimate. If people don't accept it, then it loses its value as a medium of exchange. That's why social trust and widespread acceptance are so important for any monetary system to work. Now, moving on to the need for money. Why do societies develop money in the first place? Well, it's mainly because of the need for a convenient way to store and transfer value. Bartering can be complicated and inefficient, especially when there are many different goods and services. Money simplifies this process, making trade easier and more efficient. All these points tie into the overall theme of understanding what makes money functional and valuable. When exchange is easy, acceptance is widespread, and the need for efficient trade exists, money naturally becomes an essential part of our economic lives. Let's explore some fundamental concepts of money. First, we have the medium of exchange. This simply means money is what we use to buy and sell goods and services. It makes transactions smoother because everyone agrees on its value. Next, there's the store of value. This means money can be saved and used later without losing its worth over time. It's a way to preserve wealth. Finally, we arrive at the term money itself. Money embodies both these functions. It facilitates exchanges and stores value. Understanding these key points helps us see why money is such a vital part of our economy and daily lives. Let's take a closer look at some of the modern forms of money that we use today. First, we have currency notes, which are the physical paper money issued by the central bank. These notes are tangible and easy to carry, making everyday transactions straightforward. Next, we have bank deposits. These are the funds stored in our bank accounts, which we can access through various means like ATMs, online banking, or tellers. Even though they're not physical cash, they represent a claim on the bank and are a very common form of money used in transactions. Then there are checks. Checks allow us to make payments directly from our bank accounts to others. They're a bit more formal and are often used for larger transactions or in situations where electronic transfers aren't preferred. All these forms, currency notes, bank deposits, and checks, are considered modern forms of money because they facilitate transactions in increasingly digital and paperless ways. They connect to the overall theme of how money has evolved from physical to more sophisticated, convenient forms of financial exchange. Today, I want to talk about the issuing authority of our currency notes, which is the Reserve Bank of India, or RBI. As you know, the RBI is responsible for issuing and managing the currency notes used across the country. These notes are recognized as legal tender, meaning they are officially accepted for the payment of goods and services. When we say legal tender, we mean that these notes must be accepted if offered in payment, and they hold the backing of the government. The currency notes issued by the RBI serve as the official medium of exchange, ensuring smooth and trustworthy transactions in our economy. So, in essence, the RBI's role is crucial in maintaining the stability and integrity of our currency system, making sure that the currency notes we carry are valid and reliable for everyday use. Let's take a look at savings and current accounts. These are fundamental banking tools that help us manage our money effectively. With savings accounts, you can earn interest on your deposits, which means your money grows over time just by keeping it in the bank. It's a great way to save for future needs or emergencies. Current accounts, on the other hand, are primarily used for daily transactions, like paying bills, receiving salary, and making frequent deposits or withdrawals. While they usually don't earn interest, they offer the flexibility needed for regular banking activities. Now, when we talk about bank deposits, we're referring to the money you place into these accounts. Deposits are the foundation of your banking relationship. They're what enable the bank to lend money to others, and in return, they often pay interest to depositors. So, understanding how these accounts work and the interest you can earn from savings accounts helps you make smarter financial decisions, aligning with the overall goal of managing your finances wisely. Now, let's move on to some of the key methods banks use to facilitate transactions. First, we have written instructions to the bank. This includes any formal requests or instructions given in writing, which ensure clarity and a clear record of the transaction. Next, there's the cashless transfer system. This is a modern and efficient way to move funds electronically, reducing the need for physical cash and speeding up the process. It's particularly important in today's digital banking environment. Finally, we have the check system. Although it might seem traditional, checks still play a crucial role, especially for larger transactions or formal payments. Checks provide a secure and traceable way to transfer funds, adding an extra layer of safety. All of these methods are interconnected and contribute to a smooth, secure, and reliable banking experience, which is at the core of our overall theme of financial efficiency and security. So let's talk about loans with interest. These are essentially borrowed sums of money that come with a cost, interest, that you need to pay back on top of the original amount. This type of financing is commonly used for various purposes, especially in production, where businesses need capital to fund their operations or projects. When we refer to credit, we're talking about the broader concept of borrowing money or access to funds, which can be in the form of loans, credit cards, or other financial arrangements. The key point here is that credit allows producers and entrepreneurs to access resources they might not have readily available, enabling them to invest in their production processes or expand their operations. Understanding these financial tools is crucial because they help facilitate growth and development, but it's also important to manage them wisely to avoid excessive debt. This slide highlights how borrowing, whether through loans with interest or credit, plays a vital role in supporting production activities and overall economic activity. Let's take a closer look at some of the key factors that influence credit agreements. First, interest rate. This is essentially the cost of borrowing. It's important because it affects how much you'll ultimately repay. A lower interest rate can make a big difference in your total repayment amount. Next, collateral. This is what you offer as security for the loan. It could be assets like property or equipment. Collateral provides reassurance to lenders, reducing their risk and often leading to better loan terms for you. Then we have the repayment time. This is the period over which you'll pay back the loan. Longer repayment times can mean smaller monthly payments, but they might also mean paying more interest overall. It's about finding the right balance for your cash flow. Finally, the terms of credit encompass all these elements: interest rate, collateral, repayment schedule, and define the specific conditions of your loan agreement. Understanding these terms is crucial because they directly impact your financial planning and the success of your borrowing. By carefully considering each of these points, you can better navigate the credit process and make informed decisions that align with your financial goals. Now, let's take a look at the role of banks and cooperatives in providing financial support. They typically offer low interest rates, which makes borrowing more affordable for those who need it. This is especially important in rural or underserved areas where access to capital can be limited. When it comes to formal credit, these institutions are key players because they follow structured procedures and regulations, ensuring that the lending process is transparent and reliable. Their involvement helps promote financial inclusion, allowing more people to access the credit they need to invest in their farms, businesses, or community projects. Overall, banks and cooperatives are vital components of the financial system that help foster economic growth through accessible, affordable, and formal credit options. Let's talk about moneylenders. Often, they charge high interest rates, which can quickly lead borrowers into a debt trap. This means that what starts as a small loan can become overwhelming as the interest keeps piling up. It's a cycle that's hard to break free from. Now, many people rely on informal credit sources, like local moneylenders, because they might not have access to formal banking systems. While this can seem like a quick fix, it often comes with significant risks, especially if the interest rates are sky-high. Connecting this to the bigger picture, these practices highlight the vulnerability of those who lack formal financial options and how informal credit can sometimes deepen financial struggles. It's an important part of understanding the broader challenges in financial inclusion. Let's talk about women empowerment, which is a vital part of our overall development strategy. Empowering women means giving them the tools, resources, and opportunities they need to thrive economically and socially. One effective way to do this is through low-interest loans. These loans make it easier for women to start or expand small businesses, invest in education, or improve their homes without the burden of heavy interest rates. Another key point is the role of self-help groups, or SHGs. These groups bring women together to save money collectively, access credit, and support each other in entrepreneurial ventures. SHGs foster a sense of community, build confidence, and enhance financial literacy among women. When we combine women empowerment with accessible financial tools like low-interest loans and the strength of self-help groups, we're creating a sustainable model for gender equality and economic development. This approach aligns with our overall goal of inclusive growth, ensuring women are active participants and beneficiaries in our development journey. Let's talk about income and interest today. First, having income that generates money is obviously good. It helps us build financial stability and reach our goals. But then, there's high interest. High interest rates can become a real burden, making borrowing more expensive and potentially leading to debt problems. So when we ask, is credit good or bad? Well, it depends. Credit can be a powerful tool if used wisely, helping us finance important purchases or investments. But if we rely on credit with high interest rates, it can quickly become problematic. The key is to understand how to use credit responsibly, balancing the benefits of access to funds with the risks of high costs. This ties back to our overall theme, managing finances wisely to ensure long-term stability. Now let's talk about formal credit and why it's considered better. When banks extend formal credit, it typically involves proper documentation, clear terms, and legal agreements. This makes it more reliable and secure for both the lender and the borrower. The Reserve Bank of India, or RBI, plays a crucial role here because it controls how banks operate, especially when it comes to giving out credit. By setting rules and guidelines, the RBI ensures that banks follow proper procedures, which helps maintain financial stability. In summary, formal credit is safer and more trustworthy, and the RBI's control over banks ensures that this system functions smoothly and responsibly. This control is key to keeping our financial systems stable and secure. And here we are at the final slide. I just want to wish everyone the best of luck with your exams. Remember, all the hard work you've put in will pay off. stay confident, and keep a positive mindset. If you enjoyed this presentation, please like and subscribe for more content like this. Your support means a lot and helps us to keep creating helpful resources for you. And finally, thank you so much for your attention and engagement throughout this session. Good luck once again, and I hope to see you succeed in your exams.